Let's dive right into this explainer. Welcome, everyone. Today, we're breaking down a massive update, Chapter 22 of the newly enacted Income Tax Act, 2025. This entire chapter focuses on offenses and prosecution, stretching from Section 473 all the way to 498. If you're a chartered accountant, a tax professional, a student, or a business owner, getting your head around the transition from the old 1961 Act to this strict new 2025 regime is absolutely crucial. We're going to unpack exactly what these new rules mean for you and your clients. To kick things off, I want you to consider this very real-world scenario. Let's say your client is undergoing a routine assessment and they simply fail to produce their books of accounts, or maybe they panic and actively try to hide a piece of property to avoid tax recovery. Can they actually face rigorous imprisonment for this under the new law? Well, the short answer is an absolute yes. The severity of noncompliance has been sharply and strictly codified in the 2025 Act.
Here's our roadmap for today's explainer. We'll start with a brief introduction, move into the legal provisions, do a detailed breakdown, look at a practical case study, discuss compliance and immunity, and finish with a quick summary.
Let's jump right into Section 1, Introduction to Chapter 22.
So Chapter 22 of the Income Tax Act 2025 has one main objective, and that is to create a very strict deterrence against tax evasion. As we move away from the 1961 Act, you'll notice the legislature has simplified the language, but trust me, the teeth of this law are sharper than ever. For our seasoned practitioners watching, mapping this transition is going to save you a ton of time. Look at the table here. The old Section 276C, which dealt with willful evasion, is now Section 478. The rule requiring prior sanction before prosecution moves from Section 279 straight to the new Section 491. And the protection classifying these as non-cognizable offenses, that shifts from Section 279A over to Section 492. Keep this mental map handy.
Moving on to Section 2, Legal Provisions, focusing on key elements and applicability.
When an authorized officer comes knocking, the new Act leaves zero room for playing games. Let's look at Sections 473 and 474. Under Section 247 of the new Act, if a taxpayer contravenes a search order or even just fails to give the authorized officer the necessary facilities to inspect their books and documents, it is no longer just a slap on the wrist. The penalty is harsh: rigorous imprisonment for a term that can extend up to 2 years, plus a fine. Simply failing to cooperate now carries a mandatory and severe penalty.
Next up is Section 475, which deals with fraudulently removing, concealing, or transferring property. If a taxpayer owes dues and intentionally transfers an asset just to prevent it from being attached under a Section 413 recovery certificate, they are committing a massive offense. The key takeaway here is that any active, deliberate attempt to hide assets and frustrate the tax recovery process is an immediate trigger for prosecution. And again, we're looking at up to 2 years of rigorous imprisonment and a fine.
Let's get into Section 3, a detailed explanation of willful evasion under Section 478.
Listen, as a tax professional, this is the heavy hitter. Section 478 is the most critical provision you'll deal with. It directly penalizes the willful attempt to evade tax, penalties, or interest, and the deliberate underreporting of income. Let's break down the financial thresholds because the stakes escalate incredibly fast here. If the evaded tax or the tax on the underreported income exceeds 25 lakh rupees, the taxpayer faces a minimum of 6 months and a maximum of 7 years of rigorous imprisonment plus a fine. If it's below that 25 lakh threshold, the punishment is a minimum of 3 months up to 2 years of rigorous imprisonment plus a fine. Crossing that 25 lakh mark totally changes the legal landscape for your client.
Now, before anyone panics, the law isn't just about punishment. It actually has built-in checks and balances. It's really important to reassure your clients about these structural safeguards. First, Section 491 mandates that prosecution cannot just happen out of nowhere. It requires the prior sanction of the principal commissioner, or joint commissioner appeals. Also, Section 492 makes it clear that under the new Bharatiya Nagrik Suraksha Sanhita 2023, these offenses are deemed non-cognizable. That means an assessing officer or police officer absolutely cannot unilaterally initiate an arrest without a warrant. But a quick warning. Under Section 493, entries in the department's custody are fully admissible as evidence in court.
All right, Section 4. Let's look at a practical case study of an evasion scenario.
Imagine this sequence of events playing out in real life. Step 1. During an assessment, the assessing officer discovers a significant amount of concealed income. In Step 2, the taxpayer panics. They quickly transfer a piece of commercial real estate to a relative, hoping to block the tax recovery. Bam! That immediately triggers Section 475.
In Step 3, the department doesn't just show up and arrest them. Instead, they meticulously gather evidence of the transfer and seek formal sanction from the principal commissioner under Section 491. Finally, Step 4. Once that sanction is granted, prosecution is officially initiated in court. This step-by-step flow is exactly how the 2025 Act functions in the real world.
Let's move to Section 5, compliance points and seeking immunity. So, now that we know the risks, how do we mitigate them? Thankfully, the new Income Tax Rules 2026 provide some highly specific compliance mechanisms for cooperative taxpayers. First up is Form 161. Under Section 440, subsection 2 of the new Act, a taxpayer can use Form 161 to apply for immunity from penalty and prosecution under Section 478, assuming they meet the criteria after an assessment order. Then there's Section 519. This gives the central government the power to offer immunity from prosecution in exchange for vital evidence regarding tax evasion. Note that this power is valid for 3 years starting April 1, 2026. And finally, under the 2026 rules, the Dispute Resolution Committee, or DRC, can step in to grant immunity.
But let's be crystal clear here. Immunity is a privilege. It is definitely not a right. To successfully get immunity from the DRC, your client must have paid the tax due on the returned income in full, and they must have fully cooperated during the proceedings. Plus, no prosecution can have been initiated before they apply. On the other side of the coin, immunity will be yanked away instantly if the taxpayer is caught providing false evidence or if they get convicted under serious laws like the Prevention of Money Laundering Act or the Benami Transactions Act.
Now, for Section 6, common practical issues.
Let's tackle a huge myth I hear all the time from professionals advising their clients on Chapter 22. The biggest misconception out there is that if the tax department finds a discrepancy, the police can just swoop in and arrest the business owner without a warrant because tax evasion is a cognizable offense. That is absolutely false. The reality, as per Section 492 of the Income Tax Act 2025, is that these offenses are strictly non-cognizable. The proper, formal channel of getting sanction under Section 491 is 100% mandatory before any prosecution starts. Explaining this to your clients early on will prevent a lot of unnecessary sleepless nights.
Finally, Section 7, summary and key takeaways.
Okay, let's bring it all together with our main takeaways. Number 1. Map the changes. The old 1961 evasion penalties under 276C now sit directly under Section 478 of the 2025 Act. Number 2, watch that 25 lakh rupee threshold like a hawk. Crossing it triggers 6 months to 7 years of rigorous imprisonment for willful evasion. Number 3, actively hiding assets to block recovery is a heavily prosecuted offense under Section 475. Number 4, remember the safeguards. Section 491 means mandatory sanctions are required before any prosecution. And number 5, be proactive. Use Form 161 and the Dispute Resolution Committee provisions to secure immunity for your cooperative clients.
As the 2025 regime takes full effect, the big question you need to ask is, are your clients' compliance systems robust enough to handle these strict new realities? It's definitely something to think about. Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.